Hello, YouTube world. My name is Philip Sirius. This is my brother Andrew Sirius, and we're going to talk about the most exciting topic in real estate.
It is the most exciting topic.
It's tax depreciation. Here we go.
And after that, we're going to go into accounting, and then we're going to go into different sediment layers. The theory, different types of rocks, like igneous and
I don't know these words, but I have
metamorphic.
Heard them before. There we go.
There's three types. Anyways, depreciation is actually a very powerful component of why real estate is so great. Our little ideal thing, ideal acronym, income.
It's the second one, not because it's the second one we like to talk about, because it works in the word.
The other three, I'm not even going to tell them. You're going to have to, the video is in the description. You can go look at it yourself. But income and then depreciation. And it's so important. It gets its own letter in this special acronym.
It actually is very important, and it really has everything to do with taxes. And so this might be different for anybody who's investing in real estate not in America, but for American taxes, it is a very important thing. And let me just kind of go
Although I would say it's conceptually both taxes and there's a real version and there's like the government version. And like with many things, the government version is fake, but it's real. And why don't you explain that?
So the idea behind depreciation is, in a normal business, you buy office supplies like a dry board eraser. Those are just expenses throughout the year that you have to pay for. You have profit, you have expenses, the rest is your income or profit. Now, what if you have to do a really big purchase for an item that is going to last many, many years, such as a vehicle, such as the one I always like to think of as scoreboards at stadiums. You're going to buy a big scoreboard, it's going to cost millions of dollars.
That's the one you like to think of?
It works for my brain. You put that in there, but that scoreboard is going to be in that stadium for many, many, many years. And so if you do an expense on that, your year's profits are going to look ridiculous because you spent millions of dollars on a big scoreboard.
It's a one-time expense. It's not something that you should consider a yearly expense. These are capital expenses versus operating expenses.
Correct. So the whole theory is, you say the useful life of this giant scoreboard is 10 years, it costs $10 million, we're going to depreciate this asset $1 million every year. That's our expense line of this asset, and so we get to deduct that from our kind of profit.
And the government has different, basically, depreciation schedules for all sorts of different things. It's like, I think with furnaces, it's like, or with hot water heaters, it's like 8 years. The furnace is like 50. Don't quote me on this, but it's all over the place.
Now, the reason is because that scoreboard might last 15 years, but the life of the value of it is only 10. So you take that 10 million, you divide it by 1 million every year, and so you depreciate your tax basis is basically $1 million less each of those years.
Yeah, now that is how the government looks at it. They put these different types of assets into different classes, and they depreciate it over the time, and the idea is at the end of that schedule, that asset is worth nothing. Now,
you might still be able to use it.
In real life, it's a bit different. I mean, you buy a car, you drive off the parking lot, it's worth 15% less. It is depreciated in real life. Now, we're talking real life, okay?
Yes.
Government's
it's
over
why
here.
It gets confusing.
They're
different.
You drive it off 15%, you lose value. Things lose value. They don't necessarily lose value consistently. Some things eventually start to appreciate. A baseball card, from 50 years ago shouldn't really be worth anything, but if it's a collector's item, it becomes worth more. So like Lamborghinis can increase in value, whereas most cars.
We're YouTubers, so soon we're gonna have to get those Lambos.
Yeah, and we're gonna have like slow motion videos of them going on. So it's very, very important.
Yeah.
Very important for you to know how much you're missing out on our incredible lives.
Exactly.
I mean, our lives are depreciate. Our lives appreciate because they're just so awesome.
Exactly. As soon as you're on YouTube, we'll
cut this out. Anyways, in real life, various items lose their value over time for the most part. But that is not true of real estate.
This is why real estate's super weird in tax terms. Yes, because the government views real estate to be like any other asset that loses value over 27 and a half years. No idea why they picked that number, but they did, and it's weird, but they did. So over 27 and a half years, you take the purchase price of the building or the basically the improvements to the land, you get to depreciate that cost over 27 and a half years, and you get to basically deduct it from your profits for the year and your taxes.
We're going to do some math real quick, so we're going to throw up numbers on the screen. I'm going to do some crazy editing, but you buy a property for $100,000. Generally generally speaking, the government considers it to be both a building, an improvement, and a piece of land. Mm-hmm. Most of the time, they'll split it 80%, 20%. 80% is for the improvement. You don't depreciate the land. You only depreciate the improvement.
If you bought a house for $100,000, $80,000 should be the depreciable asset. $20,000 should be the land.
And then they also break it up by residential and commercial. So residential is 27.5 years for no reason at all, and commercial is 39.
They just picked the worst number. I mean, they could have just gone 30 and 40, but for some reason they decided to make it more difficult.
They just do the dumbest things ever. So you got an office building, it depreciates over 39 years, a house over 27.5. But as you can see from this extremely technical chart that took us hours to put together, the value of properties goes up over time. It appreciates, I think, actually slightly faster than the rate of inflation, over historically speaking, whereas your value in the property is considered depreciating. Now, why is
the government thinks it's going down?
This is all fake, but it's real for accounting. Now, why is this important?
Because you pay less taxes. Because if you make a big profit, and the government, you can say, well, I lost money because my house depreciated in value. You can take that fake loss and put it against your actual profits, and you don't have to pay basically income tax.
So let's say you bought a house. We're going to change it to $125,000. So the house is the improvement is $100,000. No, the improvement is $275,000. So let's make this real simple.
Yes.
Every year it goes down $10,000, okay?
Yes.
So it goes down $10,000 in value each year. And let's say your income from that property, your positive cash flow from that property, the money you'd be pocketing is $10,000. Normally speaking, that would be taxed. $10,000 of income is taxed at whatever rate. But because you had this fake loss, your tax rate is nothing. You pay zero.
And the actual value of the house is slowly going up. And that was some crazy editing on this video.
No, it's awesome really mad editing, and also charts. And we got more things, because you can, in 1986, they changed the law so you can't use depreciation to count against your income if you have a job. Unless you're an active real estate investor. That means you work 750 hours a year. That's really important. Okay, in real estate, in your real estate business, you can depreciate any loss you have on the property, or on anything else. So if you have another side business, or you work part-time or something like that, you can depreciate all of that. Of course, you should talk to an accountant and all the rest of that.
There are some technicalities with this, but basically you can't just go, I'm a doctor, I make tons of money, I'm going to buy tons of apartment buildings.
This is what they used to do.
And that's why they had to change the law.
People would, like lawyers, doctors, accountants, they're just buying houses.
They buy real estate just to offset their taxes rather than as actual investments, and it caused some problems. So they changed that, and now basically you can depreciate active income against active real estate assets, or passive against passive, and that's how they do it.
And so now the next point is there is one disadvantage of this, is the government does eventually decide that you do have to pay this back when you sell.
Yes.
And so, but there are advantages here too. I mean, the capital gains rate, which is anything sold that you've owned for over a year and sold, you'll get the capital gains rate. It ranges from zero. It's either 0%, 15%, or 20%. It's basically always going to be 0% up to $40,000, 15% up to like $450,000, and 20% above that. Now, okay, now we're getting really complicated. So here's what you bought the property at. This part will be the capital gains. Okay.
Yeah, in between your sales price and your purchase price, any profit made, if you own the property for more than a year, is capital gains. So you buy it for $100, you sell it for $125, you pay capital gains on $25,000.
And as we all know, the government loves simplicity. They try to make things as simple as possible, particularly the U.S. tax code.
Yes.
And so this part, the depreciated loss from whatever you purchased it at, is taxed at a different rate, of course, because
recapture.
Yes. It's called the recapture rate.
You're recapturing the depreciation. Yes.
And this rate is 25%.
Yeah.
So generally speaking, if you're doing a lot of real estate investment, your rate will be 20% on the capital gains, 25% on the recapture. But there's more. There's more, because you actually can never ever pay this ever.
Yes.
If you sell a piece of property, you can do what's called a 1031
This is such an amazing charge.
exchange.
This is government tax law right here, by the way.
The 1031 exchange, you have 45 days to select up to three properties.
Once you sell, yes, you have 45 days to select 3 properties to move your money into.
And then then you have several months, 3 months?
I don't remember the specifics.
Yeah, we'll put it right there. 3 months is to purchase the properties, and if you take all this gain and you put it into something new, then you don't have to pay the tax on it, and you've simply rolled that over, and you can keep doing this pretty much forever. And
so,
generally speaking, once you
there's one last exception. That is on inheritance.
On inheritance.
If you pass it on to a family member or something like that, then the basis rate,
you die.
the basis rate goes back up to what the property is worth once the new person inherits the property.
Ungrateful brats.
Yes.
And then they get reset.
It's all reset. So they don't have to pay if they sell it on the day of inheritance, they don't have to pay any.
Your new basis goes
gains.
from here up to here, which is even with that.
U.S. tax law in a nutshell. But here, let's just try to go again. You buy it for $100, you depreciate it down. Mm-hmm. The part you then sell it for a big profit. The part from it depreciate down to the $100,000. That's recapture. 25%. Anything over the $100,000, you pay capital gains on.
0 to 20%.
Then someone inherits it at this higher place. Then once they sell it, they don't have to pay any capital gains.
Your basis is reset to 0, basically.
Yes.
But during the whole time, the key thing to remember is your gain. I'm not going to point at that. The key thing to remember is that your gain, your cash flow throughout this time on the property, and all income, if you're an active investor, can be counted against your losses of depreciation.
Your fake government tax losses.
Your income taxes will be very low, generally speaking, if you're doing a lot of buy and hold real estate. And when you sell, you can do a 1031 exchange into a new property. And this is why depreciation gets its own letter in that acronym that is a mystery.
Yeah, because it just helps your tax. You have a totally different income potential on your money based off of not having to pay the same types of taxes while you're making that cash flow. And then capital gains isn't as bad. And honestly, a lot of people don't pay capital gains because they don't sell their properties.
Yeah.
So
that's all of it, real simplified, just like the U.S. tax code. And I think that's everything we have, other than you should...
you know what's really simple compared to the U.S. tax code is hitting the little red button underneath our channel.
They don't even tax you for it.
No. Someday they might.
YouTube might. Yeah, but subscribe to the channel.
Hit
because,
the thumbs up button.
I mean, where are you going to get this other than right here?
This is where we simplify real estate.